And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Hello and welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we're working on your financial freedom. And I thank you for joining me today. I'm going to give you my email. Send your questions in. We're actually going to address some listener email. Now, I've been a little bit behind. If you caught last week's show, we were out cruising around the Caribbean. Those emails, they stacked up. We're getting those unwound, and I'm going to bring a few on today to kind of lead us through the show. But I do appreciate your questions. They're all good questions. And guess what? If they're on your mind, somebody else out there is thinking about this thing as well. So we may as well get those out there for everyone. And you can send those emails if you do have those. Send those to me at askandy@luinc.com. Again, askandy@luinc.com. So we're going to get to some of your questions today. And this will make the show a little bit wide-ranging, let's say. Very good questions. We're going to hit a number of listener emails, and that will move us along. I'll tell you, though, if I boil these down, what's at the heart of your questions, at least these, in essence, is that you want to create passive income. That's what we talk about on this show, creating extra income to do a number of things. Number one, ease your life. You've got extra burden of costs that have gone up over the last handful of years. Yeah, inflation seems to have ebbed a little bit, still a little higher than the Fed may want, etc. But we're still dealing with the inflated costs compared to a handful of years ago. So you can create extra income to make your life easier from that perspective. That can be simply, a few extra $100 a month to even a few thousand a month in passive income. That's passive. That means you still go to your day job, do whatever you do, and that stuff comes in no matter what you're doing. That's number one. Or you go even farther and you create enough passive income to where you've met or exceeded your monthly expenses, met or exceeded the income from your job. Guess what? You can retire. You can live off of that cash flow, get rid of that job, and go out and live the lifestyle. We call that real estate retired. That's essentially at the heart of these questions as I read through these. And I want to make sure you understand, if you're new to the program, what we do as members at Lifestyles Unlimited. I'm a member at Lifestyles Unlimited. I joined back in March of 2012, so over a dozen years now as a member. I've met members that have been there even longer. I've met members that joined just a few weeks ago. Right? It's all across the board. We have over 50,000 members, so there are a lot of us out there, and it's easy to see. Lifestyles Unlimited has been around for over 3 decades now. That's a very long track record. And Lifestyles Unlimited, what we do as an organization is teach you how to invest in residential real estate, mentor you. If you need a mentor, if you want somebody by your side as you go through your first single-family transaction, maybe your 10th, maybe you're buying your first apartment community as a lead, you better be leaning on those mentors, right? Passive investors, we have mentors for you. So that's what we do at Lifestyles Unlimited as an organization. But what do I do as a member? Well, I continue to learn. I tap into that education. There's a lot of online stuff. There's a lot of in-person seminars I can go to. We just had not too long ago the Wealth and Passive Income Expo, multi-day, huge session, lots of networking, lots of education, just a lot going on. But it's incumbent upon me as a member to avail myself of these things. So I make sure that I'm looking at the calendar right now, in fact, make sure I'm tuning into that. There's some webinars, some lunch and learns, for example, coming up here on a topic that I very much value, property management versus self-management. As a 12-year member now, I'm invested in a lot of single-family houses, and we self-manage those. Well, what if we handed those over to a property manager? In the apartment world, well, does a lead investor self-manage or use a property manager? That's a discussion as well. Another good lunch and learn coming up here. Tenant Screening 101. Minimize risk, maximize reliability. Very important topic there. A lot of people that don't get into this space, that think about it, talk about it, don't get into it because of fears around the tenant. We prefer to call those residents. But if you know how to screen properly, that's your biggest hurdle right there. Get a good resident into place. It makes this business so easy. And that's what we do as members. We continue to go to these sessions. We continue to educate ourselves, to learn. We get connected with other investors in the organization, single-family investors, multifamily investors that are solely investing as passive investors in apartments, multifamily investors that are syndicators. They're putting together those passive investments for me. right? We get connected, we'll learn from each other, and we get connected with other markets. Lifestyles Unlimited, when it formed over 30 years ago, was built or formed in Houston, Texas, grew up to where I am in Dallas, Fort Worth, over into Central Texas, all of Texas, and now it's across the nation. So we're really getting national in scope. In fact, I've been putting out offers in other states. I'm invested passively in multifamily in other states. So you have to get connected with other investors, with other markets, and that's what we do as members, right? That's my job now since I've left corporate America. So we do a lot, but that helps move us forward. Why residential real estate? Again, if you're new, you might be wondering, well, why would I want to invest in a rental house? Why would I want to put my money into an apartment? Well, here's the thing. We make money 5 ways on those houses. Cash flow is the big one. That's the one that's going to get you retired, and we're going to get into that here with some of the listener questions. Equity capture, something we talk about as well. It's basically where I buy a property at a discount, I add value to it, and through that process, I create equity on top of my money that I have invested. We're going to look at a very concrete example here in a minute as well. And on top of that, we have what we call equity buildup as the mortgage gets paid down. We have just regular market appreciation on our houses and on our apartments. We have forced appreciation. That's another thing on our apartments, as well as the tax advantages. So we're able to make money multiple ways, things you can't do in your 401k or your IRA or Bitcoin, man, it's shooting to the moon right now, isn't it? It can go back down, but it's not going to pay you cash flow. Gold, not going to pay you cash flow. That's what we love about residential real estate, because that is what's going to get you retired. If you want to get more into depth on that, I've done some recent shows on that. You can go to lifestylesunlimited.com, click on the radio tab, check out Mike Harrison's shows, check out Al Gordon's shows. We talk a lot about the single family space, more concretely, some of the things we're doing in real estate, and of course the Del Walmsley show. He's going to help you with your mindset. If you don't know why we're doing this and you're stuck in a job that you hate, he's going to help you get out of that. He's going to help you see the path. But you've seen the path, some of you, and you've got questions down here. I've got one. Gentleman asks, he says, hey, I understand the basic differences between single family and investing passively into apartments, into multifamily. And if you as a listener hearing this for the first time, again, go to our website or go find the Lifestyles Unlimited Real Estate Investor Radio Show on any of the podcast apps out there, because we talk about this in the shows from time to time. So you'll see, you can get into more depth there. But his question basically, his question simply is there a, quote, rule of thumb that says it makes more sense to start in multifamily versus single family? And if I mentioned a minute ago, we joined back in 2012, and Del Walmsley, he was our financial freedom seminar, our 2-day presenter back then, and he came up to Dallas from Houston. And my wife and I, after the first day, we were talking with him just outside in the foyer there, and we asked him, Del, we loved what we learned today on single family, and we think this might be what we want to do. We had not gotten to day 2, we had not learned about apartments yet, and we asked him, what's the best course of action here? Here's what we have roughly in terms of funds. And he said, look, if you've got somewhere around $100,000 to invest, get into apartments. Do it now. If you're under that, well, you might want to look at single family to build up your capital. And this gentleman here, his example was, hey, if I have $70,000 that I can invest today, where should I go? If I have $250,000 to invest right away, where should I go? And again, Del would tell you, hey, if you got $250,000, get into apartments, right? I'll tell you as well, it depends on your goals. And I would say your personality. Some people, I met on that very cruise we were on, in fact, I met another single family investor, and I asked her, are you thinking about, she's got a lot of houses. I said, are you thinking about shifting into apartments, investing passively? She said, oh no, I like the control that I have with my single family portfolio. Like me, she self-manages. So the answer to that question in part, I think, will also come down to you and your goals and your personality. But if you're looking for a, quote, rule of thumb, normally it's right around 100K. I think I've heard one of the mentors say, if you've got 75, that's maybe a good dividing line. Why 75? Why 100? Normally, as a passive investor, when I'm putting funds into an apartment investment, and I mentioned single family, that's what I've done for a dozen years, but we've been passively investing in apartments as well since 2020. Normally, there's a minimum contribution amount. And I've seen those start at 25K. I've seen those start at 50. So if you've got 100K to invest, you can easily get into 2 apartment syndications today, right? At a la 50 per investment. Or you can find more, do 4 at 25, right? And get your money working for you. get your money working for you. Now, the gentleman, he goes on, he's thinking more from the cash flow perspective because he is thinking about retirement. And yes, equity eventually can be converted into cash flow. That's how I tend to think about it. When I have a big equity capture on a house, that does not cash flow into my pocket at the moment. But down the line, what can I do with that equity? I can sell that house, get that equity out, reinvest in more houses that then thereby create more cash flow. Or I can do a cash out refinance. And the same is true with multifamily. So if you put all your money into an apartment investment, it's going to cash flow. It depends on the, well, that's another point of interest, I suppose, is it depends on the type of apartment you're investing in. Over the years, my wife and I, we've got our cash flow from our houses. So we've targeted apartment investments that are more what you would call value add. And what that means is the apartment syndicator has a business plan that says, hey, we're going to go buy this apartment community. We're going to turn it around. It needs a heavy lift, maybe a lot of construction. Maybe it's just getting a lot of the deadbeats out, right? Bringing up the rent, bringing in new families, new residents, increasing the rents, and thereby drive up the value. But sometimes with a value play like that, you may not see cash flow for a dozen months. We've got one we're in, I think we're a year and a half in now, and no cash flow. But that's okay. That was part of the business plan. We knew that going in because we know on the back end, the equity, the capital gain that we're going to get out of this thing is going to be huge. We got to wait until a cash out refinance, which is in the works now, as it were, or a sale. Now, on the other end of the spectrum, there are investment opportunities, and we see a lot of these right now, to be honest with you, on the apartment side, what we call yield plays. And these are basically cash flowing from day one. So the gentleman, he's thinking about cash flow and pondering, well, single family versus multifamily. If he's trying to get to retirement sooner than later, cash flow is what's going to get you there. So cash flow today may be what he needs to find, and that may be then a yield play. It may not have the big capital gain on the back end on the apartments, but it could be kicking off that yield already after the first quarter, maybe after the second quarter of possession. Here's where education comes into play, because you need to understand how to read the business plans, how to ask the proper questions to that syndicator, what we call lead investors that are putting this investment opportunity together, to find out, well, when do you plan to start to kick off cash? I need cash flow now, therefore, okay, value play doesn't work for me. So you learn the lingo, you learn the language, you learn the questions to ask. You get on the calls, right? They typically have webinars. You can ask the questions directly, etc. But that does come down to education. That does come down to working with your mentors to really get a grasp of the language ultimately. Now back to single family versus multifamily. I can think back a dozen years ago when we joined. First thing we did is sit down with a mentor, because we didn't exactly have our vision there. We knew my wife hated her job. That was our ultimate goal. Once we had started conversing with our mentor, they start asking questions, pulling the details out of us, looking at our capital base, what do we have to work with? And we arrived at single family, because single family, it's interesting. Apartments we tend to divide into yield and value add ends of the spectrum. The houses that we're buying are typically, they have both components. I'm going to go in and do some level of renovation and thereby drive up the value on those apartments. But that doesn't take me 12 months to do. I may do renovations on a house in 1 month, 2 months, maybe 3 months if it's a heavy lift, and bam, I get it rented. And I'm cash flowing already. So it's almost what I'm going to say in air quotes, immediate cash flow. So here it goes back again to your goals and what you're trying to do. And that mentor helped us see that for now, we're going to table the multifamily idea, because we really got to get the cash flow going today to get my wife out of her job. It took us 3 years. Got her retired. 9 houses later was what we needed. But here too, you have to sit down and figure out what you need. So is there a rule of thumb from a cash or a capital to invest perspective? Yeah, typically you'll hear about 100K is good to start investing in apartments. That may be 4, that may be 2 investments or syndications. Note that there are syndicators, lead investors in Lifestyles Limited that will lower that bar even more. I'm in an investment I was looking at the Schedule A that tells me how much each party invested, $5,000. So if you ask, you may get in for even lower out of pocket. I think that's great. Question 1, check. We're going to move on to question 2, and that $45 a month cash flow, is that a thing? Is that good? Is that bad? That's terrible. Stick around.
Learn to retire in 5 years or less through real estate investing. Learn how, learn now. Let Lifestyles Unlimited show you how. Get educated now. Text the word radio to 88007. That's radio to 88007. Join for just $297. Lifestyles Unlimited.
Listening to Lifestyles Unlimited Real Estate Investor Radio Show will change your life. Now, here's your host.
Welcome back to the show. I'm your host, Andy Webb. Thanks for tuning in today. We're getting to some of your questions on the show today, and if you do have questions, send those over to me at askandy@luinc.com. Here I've got one from Brett, and Brett, he said he's just begun listening to the radio show. He likes the idea of creating that passive income, right? That's one of the big reasons why we do that, to eventually replace his income, right? Then he can retire. But here's the interesting and maybe scary part. He says he's become more interested recently because the company that he works for is probably going to start layoffs next year. And we're almost to next year. So, Brett, get moving, first of all. Start now. And I would tell you, as we approach the end of the year, people start to think about goals and, hey, how did I do this year? What am I going to do next year? Get that going now. Figure that out now and hit the ground running in December. Don't wait until January. Especially, Brett, if you do see that on the horizon, get the education under your belt now so that you can make informed decisions about that very question we just talked about, single family, multifamily, what is it I want to do? And the good news, by the way, for someone in Brett's situation, if you're working now and you've got that, what we call that W-2 income, right? We do buy with leverage. That keeps our cash out of pocket at a minimum so that our returns are higher and so that we can actually invest more into more property. So we're making money 5 ways, not on one house, but on 5 or 10 or 20. Same with apartments. But typically, because we buy with hard money, or buy with leverage, we use hard money because the properties do need work. And when we're done, we'll refinance into 30-year debt. And typically, we're going to target that Fannie Mae or perhaps Freddie Mac backed debt. That's the cheapest loan. That's the cheapest interest rate you're going to get. But they like to see a W-2 job. So if you're in Brett's situation and you get laid off, what do you do? Am I just dead in the water? No, the good news is there's been a lot of innovation, a lot of new debt products in the past handful of years. And right now, something a lot of people are using is called a DSCR loan. That stands for Debt Service Coverage Ratio. And all that means is that the income from the property services the loan. In apartments, they typically want to see a DSCR of 1.25 or higher. With these loans on single family, oh my goodness. A lot of them want to see 1.0. That means you're 1-to-1 servicing the debt. Do you want to see 1-to-1 servicing the debt and nothing else? No, because then you have no cash flow. And this takes me to Brett's, actually has a couple of questions here. I'm going to hit his second question first because that's the $45 per month cash flow. And he has a very, very good question here. He says, let's say you buy a house that needs repairs and you roll the cost of those, both the purchase price and the repairs, into the mortgage. You create that equity. He says, if I want to capture that equity, if I do that refinance, that's going to push my mortgage and thereby my mortgage payment up. Isn't that going to impact the cash flow, make it insignificant? Well, it depends. That's where you have to learn. Again, it goes back to the education. What's incumbent upon us as members is to become educated and continue with that education. And really, in this case, learn how to run the numbers on each and every house that comes your way. He's talking about single family here. But you're correct. If I go out and just go straight, do 20% down, and let's say pay for whatever the repairs are out of my pocket, bad idea. Very high cash out of pocket. But yes, my mortgage rate will be lower. Therefore, my cash flow will be higher. But we don't want to be sitting in these things forever. We tell you want to sell in 3 years, something like that, 2, 3, 4, 5 years. Therefore, I'm more interested in having my cash out of pocket lower. But he's correct because I buy with hard money, and then when I do the repairs, I'm adding value. I'm pushing the value of that property up. And when I do that refi, I'm going to refinance at 75% of that new value. I often quote a house that I buy for $100, put $50K in work, and when it's done, it's valued at $200. Obviously, a mortgage on buying at $100 versus $200, the mortgage payment will be higher. So yes, through the process, that mortgage payment goes up, cash flow goes down. But we absolutely want to see a minimum number there, and we like to see anywhere from $200 to $600 right now. That's what we're seeing across the markets where we invest in terms of cash flow. But Brett, he's been out in the internet, dangerous place, be careful, watching YouTube videos, and he came across one. It's a couple there doing what we do, buying houses, distressed properties, fixing them up, renting them out. And he says that the cash flow from one of their rentals was so small that it doesn't seem like it makes any sense. One of their products, one of their videos, they said, hey, we're making $45 a month after all the bills are paid. Yeah, I agree. That's a very small number. That's not a good number. So I'm going to do my analysis on whatever property crosses my desk, and if it comes out at $45, no. Move on to the next one. Now, you, Brett, and everyone else out there do need to have your own personal goals around things like cash flow, cash on cash return, what kind of equity gain do I want to see through the value add process, and so on. We talked about this a couple shows back. Again, you can catch the shows at lifestylesunlimited.com or on any podcast app. But it's very important to know your targets. My minimum is 200, so no, that house would not work for me. Now, we also don't know, and this is an important consideration as well when you're talking to investors out there, how are they calculating that number? How are they getting to 45? And there are some very conservative investors out there, I'll say uber conservative, that when they put together their numbers, what are they doing? They're looking at their gross rent. Right, that's let's say my monthly rent is $1,500 or $2,000, whatever that number is, starting with a gross rent. We're going to have a mortgage in place. That's the principal and interest. We're going to have taxes and insurance that we accrue for. We call that PITI, acronym for all four components there. PITI, we're going to net that out. That's going to give me a net rent. But they're going to go to apply. I've seen people that apply 10% of gross rent for maintenance and 10% of gross rent for capital expenditures. That's not going to happen regularly. Those are going to be accruing over time. And then they'll add another, let's say, 8, 10, 12% for vacancy. And if you add all that in, yes, you're going to come to a very low number, possibly zero, maybe negative. I tell you, this is a very conservative approach. They're not following the Lifestyles Unlimited model. What we say is you go out and you find these properties and you do the renovations according to the motto, best product, best price. And that means going out and fixing anything that is broken now or anything that could break in the next handful of years. So what have I done in essence when I do that? I've addressed capital expenditures today. I've pulled those forward to today. And I've addressed any maintenance for at least the next handful of years, 3, 5, depending on the level of your rehab. Do it right. And that maintenance goes away to zero as well. Vacancy, if I have the best product on the market for the best price, I just will tell you from personal experience, that declines significantly. Yes, we do have some turnover, but it's very minimal. Looking back on my portfolio, I have people that have been in place in my residences, in my houses for a very long time. So if I budget for 8% vacancy, 8% represents 1 month, by the way, 12%, whatever that is, plus 10% for maintenance, plus 10% for CapEx in year one, nah. I would never do a deal. But the truth of the matter is, by following the motto, going out and addressing everything up front, essentially, I'm paying for those repairs and that CapEx on day one, to the listener's question, to Brett's question, and I'm rolling that into the loan. Right? So yeah, I guess I am paying for that a little bit in the principal and the interest on that back-end loan. But rather than being $45 net cash flow like this couple, here's an example. This literally just hit my box this morning. This is in Georgia. Estimated cash flow per month, $400. Now, it is a rehab house, buying for $150, after repair value, $225. So we're going in and fixing that stuff now so that maintenance does go to zero, so the CapEx does go to zero. Now, if you plan on holding this for 20 years, then yes, you should set some money aside for those things. But again, if you follow the Lifestyles model and dispose of these in a handful of years before those maintenance items start to rear their head, before that CapEx starts to come back around, you don't have those issues. All right. We're in our final segment. I got one more question. I got to get to this one. And this one kind of taps into that motto that you hear us say, live where you want, invest where it makes sense. Because again, we are national in scope. We have members everywhere across the country, in Canada, in Mexico, in Germany. We've got a couple in Australia. I had the opportunity to meet both of them here at the recent Wealth and Passive Income Expo. Peter and Adam, great to see you guys again. So we got people investing from afar, living where they want, but investing where it makes sense. And the listener question hits on this because he resides in Washington State, and he puts it himself. This is Jay. He says, I live in and own a business in a deep blue state, Washington. But he snowbirds in what he calls a moderate to deep blue state, New Mexico. And he's wondering, he's got a couple questions here. He's wondering, given the, let's say, probability that a more liberal-leaning state could interfere with things like rent control or flagging rents, pausing rents like we saw during COVID, et cetera. In essence, he's asking, am I at higher risk if I were to invest in Washington or even in New Mexico? It's a good question, and typically we say no. If it's a very strongly, if it's not a landlord or rental owner leaning state, it's probably not a good place to go. Now, his further question is, well, what if there are cities like in California within that state that are more conservative? I would tell you, handle with care, because things come from up on high. And what if the state issues a statewide mandate? That could be a problem for you. So I would be very, very careful. Do your research, your due diligence, of course. That's where the Lifestyles Network, by the way, plays to your favor as well, because you can talk to other members. In fact, we have an ambassador in Seattle, Washington. He's got an ambassador event coming up towards the end of this month, a get-together. I met a lot of investors from Washington at the Lifestyles Unlimited Wealth and Passive Income Expo, by the way, as well, all investing out of the state because the state doesn't work. Prices are too high, rules are not favorable, etc. Now, I would tell you, be careful even in more conservative states, because there can be pockets where perhaps cities are a little bit more, let's say blue, to stick with his color coding here, blue and red, or more liberal leaning. And he goes on to ask, by the way, he says, hey, I spend my time not too far in New Mexico, not too far from El Paso, Texas. Would that market make sense? And I scratched around and looked at my network. I couldn't find anybody that has investments in El Paso at the moment. But I did just a little quick research, and you should do your due diligence as well. It looks like a good city in terms of population, 700,000 at 2020. At the 2020 census, it's increasing over time since the mid-50s, middle of last century. But you'd want to look at the business stats. What kind of economy does it have? And just a quick Google search showed me, hey, it is a little bit more liberal leaning. I didn't see anything unfavorable in terms of eviction process or anything like that, but that can change. And a good case in point is Dallas, Texas. I'm in the DFW area. I've got houses all across the market here. I don't have any in Dallas proper, the city, and I'm not telling you shouldn't invest there. But know that city has put into place its own rules. In fact, I've got the flow chart here in front of me. If you look up Dallas, Texas eviction process, they've got a flow chart for this thing. So basically they've said that if you give your eviction notice, the resident has 10 days to give the owner documentation of some sort of way that they're trying to address the situation, like, for example, applying for rental assistance. And when that happens, if they have done that, now they have 60 days, right, from the receipt of that original notice to cure whatever the problem is, i.e. pay their rent. If they didn't, yes, owner, you go straight to the eviction court. But clearly Dallas, the city of Dallas, has put into place its own rules. City of Austin, probably also very, very, very liberal city. So I would look very closely at what the specific rules are there. And just know, as an investor, even investing in Texas, you do need to look at your municipality. So I think that's from Jay, very, very good question. Washington State, forget about it. New Mexico, I don't know. Do your due diligence there. El Paso, talk to some people. Sounds like it might be a little bit leaning the wrong direction, but that will be up to you to do your due diligence. So great questions all across the board here. And we've hit a variety of topics here fairly quickly. Again, if you missed anything from the earlier part of the show, if you're just tuning in, you can go to lifestylesunlimited.com, click on I believe it's now a podcast tab, to catch the prior shows there. You can go to any of the podcast apps and you can tune in a week. I had a lot more prepared for you. I wanted to get into the notion of year end and some of the to-dos, both from a strategic perspective as well as, let's say, more tactical, and maybe some things you might want to think about from the tax planning perspective for this year, right? How to reduce my taxes. We'll bring this up next week. We're going to take that up for next week's show. Just good questions on your part. Keep them coming in. I like to bring these up on the air with you because, again, if you're thinking about it, someone else is. And to guys like Brett, if you see some risk on the horizon with your JOB, take action now. Is now a good time to invest in real estate? It absolutely is. If you're following the right model, you learn how to create your own economies, you buy at a discount, you create equity, you build that cash flow, make sure it's $200 or greater, not $45. You'll find your financial freedom, and reliance on that ever risky job goes away. So I appreciate you tuning in. Again, your questions, send to me, askandy@luinc.com, and we'll see if we can work those up in a future show. In the meantime, remember, it's not the money, it's the lifestyle. You have a good day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.